Hello and welcome to Meet the Experts, an exclusive series where we interview successful popular investors who will share insights around what has led to their consistent success, as well as sharing some of the challenges that come as a result of being a popular investor. I'm your host, Triangulating Salmi, and each month we'll be sitting down with some of eToro's popular investors to uncover some market insights and for them to actually share some of the tools and resources that have helped them with navigating some incredibly volatile markets. Whether you're new to investing or trading, or whether you're experienced, you're bound to leave today's episode with some insights that can help improve your approach. So let's dive in. Joining us today, we have Pietari Laurila. So first of all, could you introduce yourself and give us a detailed rundown of what it means to be a popular investor?
Sure. So nice to be here, Trajan.
Yeah.
I've been investing for 20 years. I've been a full-time investor since 2011, and I've been on eToro since the end of 2020. I've always invested in stocks. So what it means to be a popular investor. So what I do is I invest my own money on eToro, but my portfolio is public, and anybody can see what stocks I trade, when I trade them, what's in my portfolio at any given time. So then if they like what I do, if they like my performance, then they can copy me on eToro. So that means that they get the same stocks in their portfolios as I have in my portfolio. I've been on eToro for about 4.5 years now. Today around 11,000 people copy me on eToro.
Like why eToro? What made you choose the platform, as well as what led to deciding to becoming a popular investor?
So like eToro, I really think that copy trading is very innovative feature of eToro. And I don't think anybody else does it like in the same way as eToro does. And it has like a few good things about it. So first of all, like eToro doesn't charge like anything extra to use the copy feature. So it's the same thing like if you buy the stocks for yourself, or if you copy somebody and then you get the stocks via the copy feature into your portfolio. So there's no like extra fees for using it. And it's also completely transparent, meaning that you can see all the trades that the person who you are copying does. You can see the portfolio at all the time. And finally, I would say the kind of interactivity of it. That's another good point about it. So the fact that you can ask questions on the eToro feed, like why did you buy this stock? Why did you not buy this stock? What do you think about this stock? Things like this. And if you compare copy trading to like more traditional forms of wealth management, then asking these types of questions, I think, would be a lot more difficult. Plus, if you ask a question on the feed, then anybody else can also see the answer and they can benefit from that interaction. So I think that overall, like this is a very disruptive model and a kind of like a very innovative, like technology-led model of wealth management.
Absolutely, I think that people that definitely benefit from the community that eToro has been able to create. And you mentioned that you've been investing for 20 years. So what exactly was it that drew you towards investing in stocks? And also, you mentioned there are over 11,000 copiers. So do you mind sharing roughly how many assets you have on the copy, as well as your average yearly returns?
Sure. So there's 11,000 people copying, and the amount that they're copying with is a bit over 30 million US dollars. Now, as for what drew me into investing, it was really like a coincidence. So I was studying computer science, so something totally different at university. And then just by chance, I took a finance course at university. And then I got really interested in that subject. I studied it more on my own. I read a lot of books. And then after that, I opened my first trading account. And in the beginning, I really didn't have like many expectations about that at all. Because if you study finance at university, what they will teach you is that the market is efficient. So what that means is that there's a lot of competition out there, and it's very difficult to beat the market, difficult to make money. So that's why I didn't really have a lot of expectations about how everything would go. But to my surprise, it started to go pretty well from the beginning. So the first year, I made 100% profit. And then I thought that, what's going on? Like, how come? Like, would this really be possible to do? And then, yeah, it just continued to go well. And then after 7 years of doing it, I decided that, okay, I'll just do this full time. Then, so that was back in 2011. So if you look at the returns for the last few years, then I mean, every year has been positive. The past 10 years, I think it's between 15 and 20% a year returns.
That is incredible. Absolutely incredible. It's funny, yeah, it's funny I guess like your story of like how you stumbled into it as well. That is really impressive. And also like investing and trading for yourself is one thing. But then how do you go about balancing your expectations and the responsibilities that come from managing over $30 million? Because I'm sure that like making that shift wasn't easy. So how like what are some of the, I don't know, practices or some of the habits that you have in place that allow you to manage not only your expectations but also your copiers, particularly in times when the market's underperforming?
So like when I joined eToro, I was a little bit worried about that. Like how would it feel like when your portfolio goes down and then, like you have copiers, and will you feel under pressure, and maybe will you kind of feel that you should somehow change your strategy? And then the risk would be that you cannot be true to yourself, and you would start doing something which you shouldn't be doing. So would your focus become kind of too much short term? Because in investing, you really have to take the long term view to be able to successful. Otherwise, I mean, it's not possible. So I was a little worried about that, but I mean, to be honest, uh, I've kind of been positively surprised about the fact that like most copiers, they are really understanding about like the kind of drawdowns that my portfolio has gone through. I mean, maybe it's because like the last few years they've been relatively easy for my strategy. So in 2022, a lot of people they lost quite a bit of money, like 20%, even 30% if they invested in like tech stocks. But my portfolio was kind of stable in 22 because I invested more in value stocks. So we haven't yet got like a massive drawdown over the past 4.5 years when I've been on eToro. So we'll have to see like how it goes when eventually the drawdown will of course come. But so far, I found that at least through these like smaller drawdowns, the copiers have been kind of like, I mean, quite understanding. I mean, yes, you get like the people who complain about it, but that's kind of part of the game, right? I mean, when you're a public investor, like anybody can say anything, um, and you just have to understand that that's going to happen, and you have to kind of stay true to your strategy. I mean, fundamentally, that's the important part. You cannot just be changing your strategy because somebody is saying that you are doing something stupid or you should be doing something different. I mean, you can take feedback, but you also have to have your own kind of view and ultimately your own opinion about things and how the market is going to behave and where it's going to go.
Hmm. Yeah, absolutely. Absolutely. Definitely makes sense. And I guess like as you've mentioned that like your strategy and your approach has led to such consistency, even in times when there has been those downturns within the market, has your strategy changed at all over the years to, I guess, improve your consistency and improve your returns? And what principles guide your investment decisions?
So I've done like a few different things over the past 20 years because I've been in this game for a long time. And the first thing I did was actually something totally different to what I do today. So I did day trading, like very kind of fast paced kind of trading. So you would only hold for a few hours or maximum one day. So for the first year, I did that, but it was quite stressful. It generated good returns, but I had a full-time job back then, and it was just too much. So then after that, I invested for 10 years in smaller companies like microcaps. So these are companies which are only followed by, one analyst, maybe zero analysts. And back in 2005, still in even 2010, this space, there wasn't that much competition. So it was not too difficult to make money with these companies. Then the competition increased around 2014 in this space. And then I developed my current strategy, which I run today and which I've been running for the past 11 years. And so when you are in the game for long enough, then I think the reality is that the market always changes. The competition increases, and then you have to do something a little different compared to what you did previously. So you cannot like stand still, because if you do, then some other people are ultimately going to eat your lunch. So you always have to keep like evolving your strategy a little bit. Like try new things, see if maybe some other things are not working. Then you can maybe read some new research, try to find some new ideas from there, and then incorporate some elements from that into your strategy.
Nice, that's fantastic. And yeah, it's definitely important. I guess like there have been like times where I guess you've seen like people have, let's say, outperformed for 2 years or something like that, and they find their strategy no longer works with the current market conditions. So it's great to hear that you're constantly looking for, I guess, like ways to adapt and change and improve your overall approach to it. And I saw that the majority of your portfolio is invested in European financial companies. So could you share like why that's the case? I guess with the majority of popular investors, you see that a lot of these investors they invest in the US markets, and obviously that's led to some drawdowns in their portfolio. So what's led to you going elsewhere?
So I've been investing in Europe for like a few years, and it's always been the wrong call because the US has been outperforming Europe for such a long time. But I've been a little bit stubborn with that. So my thesis about the European financials is kind of twofold. So the first thing is valuation. So I think they are cheap. So if you look at a lot of the banks in Europe, then what you find is that you can buy like decent quality banks for around 7 times earnings. And if you look at the longer term valuation history of these companies, then a typical bank, it should trade at around 10 times earnings. And now you can buy it at 7 times earnings. So my thesis is that over time, the valuation of these banks is going to normalize. And then maybe they are going to go from 7 times earnings to 10 times earnings. And then that's how, like the portfolio is going to make money. So this is like one part of the strategy, like kind of the valuation. But then the second thing is the economic trend. So now what we are clearly seeing this year is that in the US, the budget deficit is going down because they've run a very big budget deficit for a number of years that has really strengthened the US economy, but they cannot do that forever. And it seems like the Trump administration wants to reduce the deficit. Like you have the Department of Government Efficiency headed by Elon Musk and other initiatives. Whereas in Europe, it's the opposite. So you got the chairman of fiscal expansion, like more investment in defense, in infrastructure. And this is going to strengthen the European economy next year and in 2027. So you have kind of a combination of cheap valuation for these financial stocks and then an improving economy over the next couple of years. So I think this cocktail is really kind of why I really believe in these companies at the moment.
That's really interesting. And I guess with regards to what you mentioned about the budget deficit, could you explain what a budget deficit is for the listeners that aren't aware of what that is, as well as you also mentioned how I guess like when it came to focusing on European companies, that there was, I guess, that stubbornness. Like, were you ever drawn towards the US? Like, were there times that you were tempted to open positions in US tech companies, for instance?
I wouldn't say I was really tempted to open positions in US tech companies because it's not really kind of my style of investing or my area, let's say. When you invest in tech companies, then the type of analysis that you have to do is quite different from when you invest in these old economy companies like banks. So with tech, you really have to understand the product market, like who has the best products, who is innovating, like who is gaining market share, who has like launched the latest, greatest gadget, like things like this. And it's not so important like how much money the company made in the last year, because the tech market, it can really move very fast. So in a few years, the market leadership can completely change. And you have to be aware of these trends, like who's got the best products at any given time. So because I'm more like a quantitative guy, like a more traditional kind of value investing guy, then the kind of analysis that I do, it doesn't really work so well in tech. And that's why um, by default, I don't really invest in tech. I mean, there's been like a couple of times when some tech companies actually became value stocks. Like one example would be Meta. So that it became really cheap in 2022 during the last kind of tech downturn. So I was kind of considering like buying it, and I even held it in my portfolio for just like a little while. But I never had a lot of conviction in it because it's just not kind of in an industry which I analyze very deeply. So then I sold it a bit too early. So after that, the next year it went up a lot. So kind of like a little bit of a miss there. But I mean, sometimes you do find that some like good companies, even in tech, they become cheap, and then you can buy them. And then if you hold them for a year or 2, 3 years, then you can make a lot of money.
Hmm. Yeah, no, I definitely, yeah, no, I definitely recognize what you said, particularly with, I guess, the different type of approach that's required for these tech companies. And I guess given the current state of the world, like as you mentioned, I like budget deficit, there's like these tariffs going on, there's geopolitical tensions. How do you think that the markets will likely perform over the next 6 months?
So it really depends a lot on President Trump, because like the market, you can really see in the last month, it first went down because of the tariffs. So people thought that maybe he wouldn't like put the tariffs like as big as he did. Then the market plunged like very quickly. And then people were saying that, he's not going to U-turn. So previously he always U-turned. Now then the view became that no, he's actually really serious about this. It's just going to keep the tariffs on China, everybody else. So this is going to be like really bad. But now it appears that actually again he is U-turning, and then that's why the market's been going up. So it really depends like what he's going to do next. So who knows like what's going to happen? Like the next 6 months totally depends on like how bad the tariffs are really going to be, whether the negotiations succeed. If you get a success, like a good success out of the negotiations, then I think that the market can go up. But equally, like if the tariffs become worse, then I think the market is going to continue to go down. So that's really critical. But I would say that if you look at bit beyond the next 6 months, like the next 1 year, next 2 years, then I think I strongly believe that the clear theme is going to be the European outperformance. So no matter what happens, um, whether the market goes up or down, you could outperform the world index by being invested in Europe. I mean, that's my core belief at the moment.
Hmm. And I guess when it comes to so like when it comes to I guess like the European companies outperforming these American ones, and obviously you've shared a lot about your approach being I guess more structured around fundamental analysis. Do you use technical analysis at all when it comes to let's say you've identified a company and you're looking for a good entry point? Is it solely based off of things such as the PE ratio like you've mentioned previously? Or do you also combine technical analysis with your strategy as with regards to finding your entries?
So I do use a little bit of technical analysis. It's not like the big part of my strategy, definitely not like the main part. But I do use it like to try to pinpoint the entry points and exit points. So I like to buy stocks which are oversold, and I like to sell stocks which are overbought. And I look at the chart of the stock. So I try to identify any support levels or any kind of trends that the stock might be in. And then I would like to buy it when it's more towards the bottom of the trend, close to the kind of the lower trend line. And then I would like to sell it when it's more towards the top of the trend, so kind of close to the top trend line. And I also use technical analysis for risk management. So sometimes I'm holding a stock and then it's going down. So then you start to wonder, so what's going on? And the worst situation is always that you cannot find a reason. So it's just going down, and then you are like, okay, like why? And no matter how hard you look, you don't find anything, like no news, nothing seems to be going on. So then actually in this type of situation, especially if the stock has breached some kind of support level, which is clearly on the chart, I become more cautious, because then I think that maybe somebody else knows something about this stock that I don't know. And that's why they are selling the stock. So then I will at least wait for the next earnings release to see if there's some bad news about the company before I consider adding to that position, for example. Or sometimes I might even sell the stock if I really get like this bad vibe or bad feeling like about the stock, just because it's breached like our support level. So basically for technical reasons.
Yeah. Yeah, no, that definitely makes sense. I guess like although yes, investing you're able to make a return, it's also about learning to, I guess, like be a good loser, knowing when to cut your losses. And when it comes to, I guess, when it comes to things such as these bad investments, can you share a bad investment that you've made in the past year or two and what you've learned from it?
So past year or two, I'm not sure, but like definitely, like if I think of some like really bad investments I made during my career, then 2018, I mean, that was like a horrible year for me, because I believed too much in my macro view. So I thought that there would be no recession. And ultimately that view was correct. So there was no recession. But the economy slowed down, and I just didn't kind of adjust my portfolio for that. So I kept holding like banks and like other kind of more risky companies, which benefit from like a better economy. And actually, we were getting a slower economy that year. So like just kind of having like too much belief in the fact that there's not going to be a recession. I mean, that was my mistake that year, and that caused like a big drop in my portfolio that year. So then when something like that happens, then you start to think that, okay, how can I not repeat that mistake? So then in 2022, there was a similar situation, and then I was a lot more cautious. So I had a lot more cash in my portfolio that year. It didn't actually help that much in 22 because the market didn't ultimately go down like in the same way as it did in 2018, or at least like different stocks went down, like not the same stocks. But on the other hand, still the advantage was that you could never have lost the same kind of amount as I did in 2018, like no matter what happened. So these are the kind of like adaptations that you make after losses. Like sometimes they're successful, like sometimes they are not successful, but you kind of keep trying to like evolve your strategy to kind of improve the risk reward ratio.
So like when it comes to like these bad investments and things like that, and I guess like making sure that you're managing your risk, like obviously it's not something that's easy to do. Like yes, everyone talks about I guess making sure that there's making sure you aren't taking too much risk in certain positions, but it's something that I guess you kind of forget about, particularly once you when you've had that consistency. And I guess when it comes to other things such as like these proudest moments, like when you've made the right investments, when you've been able to obviously taking the necessary like risk precautions. But could you actually share one of your proudest moments and some of the, I guess, the mental challenges that you've had to overcome throughout your journey as a popular investor? Because obviously, as the copiers grew and as the assets under management grew as well, surely there was that mental aspect that you had to overcome along the way.
So like my proudest moment, like if I had to think back for all of the 20 years that I've been in this game, like there is one day only when like really everything just came together. And that day, it was the 8th of November. I think it was the 8th of November 2020. that was the day when the vaccine was the news came out that it works, and that was the only day I remember that I really was just jumping up and down, like punching the air, just like shouting like yes, yes, like that. And then that was, I mean, it was a massive day. I think just in that one day, the portfolio went up like 15%. That month, it was up like 30%, more than 30%, just in one month. But it was the culmination of having a strong belief about what would happen next for much of like 2020. Since about kind of May, June, I kind of got the belief that, we are going to come out of this. We are going to get the vaccine. I think that belief kind of strengthened over the following months. And in October that year, the portfolio actually went down quite a bit. So it was kind of looking like a little kind of uncertain, a little bit bad. Was this a mistake, to hold some risky stocks like at that time? Should you like be a lot more defensive, hold some cash, things like that? But like just like having that belief, like through all of that, like absolutely enormous uncertainty which we had that year, like all the lockdowns, like all the craziness, like completely unprecedented. And then that one day, you just get that announcement, and then it just changes everything. So I mean that day I will remember like for the rest of my life.
Yeah.
So yeah, so I think that's the one kind of proudest moment that I have for the past 20 years.
The mental challenges that you had to overcome when it came to actually growing your portfolio as well as the assets under management as they continue to grow.
Yeah. So the mental challenge, I think when you are in this game for long enough, then you are going to go through like these difficult periods when your portfolio is not performing. So I already talked about 2018. So I remember that Christmas that year, it wasn't like a Merry Christmas because that year had been like terrible, like the portfolio had gone down so much, and I really felt down like that Christmas. Like I really felt that like, is this really worth it? Like I mean, this is like really terrible. But in these type of situations, you just have to keep going. I mean, sometimes it's gonna be like that when you invest for long enough. And you just have to be like resilient, like just believe that it's going to get better. Eventually, it's going to get better. And now, luckily, the next year, 2019, like already I made back all of the losses from 2018. Maybe it could have taken longer. Who knows? It could have not taken like just 1 year. It could have taken 2 years. It could have taken 3 years or more. But you just had to kind of keep going and believe that in the long run, it's going to come okay. Because it's in the long run that you really make the money in this business. Like in 1 year, you can make 10%, you can make 20%. If you have a very good year, you get lucky, you can make 50%, or you can make 100%. But even these numbers are small compared to what you can make over long periods of time. Like in my case, over the past 20 years, I made like 10,000%. And that's because of the power of compounding. So just kind of making these like good returns like from 1 year to the next. But you have to stay in the game. So that's the thing like about this like about investing. So you're gonna go through these difficult times, but the kind of resilience has to be there. And also, I guess, like not getting kind of so stressed that you start to overtrade and take too much risk. Not so much risks that you cannot recover from any losses. Like leverage, for example, can be a little bit dangerous. You have to be a bit cautious about using leverage.
Mm.
So yeah, so basically staying in the game for the long run. I think that's the key.
Okay. I guess so time and time again, like you've reiterated the importance of obviously time in the market, ensuring that you're in it for the long run. And at the start of the interview, you mentioned about how you started off with trading, day trading. So how was it with regards to making that shift from, I guess, that day trading mindset to being a long-term investor? Because I guess it's not an easy thing to do. So how exactly did you navigate that change?
Yeah, it's all about like experimentation. So in the markets, it's useful to experiment with things. Like, and I think it applies to life like more generally as well. Like if you don't try things out, then you will never make, anything out of life, right? And the more things you try, the better, because eventually you will find success with something. Maybe in the beginning you won't know what it is, but eventually it's going to be something. Like in my case, for example, when I was a student, I experimented with some technology startups. I wanted to be like a tech founder, and it never worked out. I mean, I never made anything out of it. But then I started to do the investing, and then I found that, okay, this is my area. This is where I can make money, and this is where I can be successful. And then within investing, I mean, also, like, I was much younger that time, like 20 years younger. So when you are young, you can also experiment a lot more. You can take more risks, because back then my portfolio was like super small. And I knew that even if I screw something up, I can easily save the money back. I can do a bit of work, save money from my salary, and then that way I can kind of replenish my portfolio, even if something goes bad. And that gives you the freedom to experiment, try different things, take a little more risk, like when you are young. So nowadays, I'm 20 years older. This is my like main source of income. There's also the 11,000 copiers on eToro. So I mean, I don't want to like experiment to the same extent like anymore as I did back when the account was much smaller and it was just my money only and no copiers. So I think like you can take advantage of that. Like when you are starting small, you have a lot of freedom, and you can just like try even some crazy ideas, and I think eventually something will stick. You just need to keep trying.
Yeah, yeah, no, absolutely, absolutely. I definitely, I guess, like get the point you mentioned about, I guess, like seeing how you're able to take things away from these different things that you go through in life as well, and seeing how you're then able to implement it into things such as investing. And I guess as you've been in the game for 20 years, what would you say is different about investing today versus when you started? And what advice would you give to your younger self, like when you first took this leap towards investing?
So what's changed is that like people are using a lot more technology now in the markets compared to 20 years ago. So in that way, the market is more competitive today than 20 years ago. So the same day trading I did back then, it wouldn't work today because I was like reading earnings announcements, but now an AI can read an earnings announcement in 1 second, and it can immediately trade based on its understanding of what the earnings release says. So this technology didn't exist 20 years ago. In the same way, like high frequency trading, that has become a lot more advanced over the past 20 years. So you always have to kind of consider like what is the current state of the market and where there's a lot of competition, and maybe try to like kind of focus on the areas where the competition is less. Like even when I started, I focused more on the smaller companies because I knew that there's fewer people following them, and then probably the competition is less. So I think that's kind of like one piece of advice that certainly worked for me. Like don't go like where everybody else is competing, but try to find your own niche. I think today, if you were smart about using AI, I think there's going to be some opportunities like there. A lot of people are obviously already using it, like hedge funds, banks. They all try to like apply this technology to investing. But maybe if you have your own unique angle to using AI, then I would say if I was 20 years younger, then maybe this is the area that I would really focus on, like today, how to use AI to make better investment decisions.
Mm. Oh, that's yeah, it's interesting 'cause I guess especially like with the technological advancements that have taken place over the past 20 years, there's definitely there's an abundance of information out there. And I guess it's a bit of a double-edged sword. 'Cause I guess yes, you have access to all this information, but then again, at times it's sort of like, can I really trust this? Like, for instance, there have been like several occasions with earnings reports where companies have falsified some of their numbers, and then it's led to significant downturns in companies. And it is interesting, really, really interesting. And like, do you have any last words of wisdom that you'd like to share with the listeners?
Well, I think one of the things, like for many investors, is that like they tend to sell after market goes down. I've seen this a lot on eToro. So whenever the market goes down, then the number of my copiers goes down a little bit because some people get scared about the latest bad news, which has caused the market downturn. And unfortunately, like this approach, like if you sell after the market goes down, it's not a good approach. So there's some studies which say that the average investor, they lose to the market by several percentage points a year because of this behavior. So what you should be doing is either of one of two things. Either you don't care at all about what the market is doing. So this is kind of the classic approach. Okay, just buy and hold. Um, and that is it's a solid approach because then you take the psychology out of the equation. So and you can be peaceful because you don't need to worry about what's happening like next, but what Trump is going to say next. Basically, is he going to say something good? Is he going to say something bad? It doesn't matter. You're just going to hold. So then you are not going to take this kind of psychology-driven loss, which many people end up taking. Or if you want to do one better, and this is going to be quite difficult, then you can try to be a little contrarian with this thing. So when the news is very bad and the market plunge, then maybe instead of selling, you should consider buying. So if you look at some of the top hedge funds, I mean, this is what they're doing. So they can actually do some market timing successfully. And the way they do it is that ultimately they buy it from those people who are selling. Because for every buyer or every seller, there's a buyer. You cannot like sell a stock if nobody is buying it. So you have to think that who is buying during these kind of panic days when everything is going south, like everything is falling. I mean, who is buying? And it tends to be like these professionals, right, who they're quite cool-headed and they know their market history, that it's a good time generally to buy when everybody else is selling. So maybe try to be a little bit more like these guys. If you want to try it, I mean, it's not going to be easy because like the market can still fall more, like always. But in the longer run, if you follow this approach, then I think it's definitely much better than the other approach, meaning selling after losses.
No, absolutely, absolutely. I think that's also like what leads, I guess, like a load of emotional investments being made after having to go through that extreme fear of missing out. I guess like you then sold a position at a loss, only to see it then make a parabolic move, and then you're sort of questioning yourself, and it leads to irrational decision making. But it's been a pleasure spending time with you and hearing a number of profound insights around not only your approach, your journey, and your approach to the financial markets, but just also other things and how you stumbled into investing. And that was particularly interesting. And for you listeners, I really hope that you guys have found value from this interview. And I really urge you guys to share this with a friend so more people are able to gain access to such valuable insights. Until next time, and remember, consistency requires a structured approach. Thank you very much. Education is key to developing consistency in the markets, but high quality education is often expensive. That's why we've partnered with eToro to offer free access to their investing course, which is valued at $2,000. If you're serious about building your investing skills or simply want to level up your consistency in the markets, comment learn below and we'll share the details with you.